So if that being the case, to what extent can a regulatory initiative at a global level solve some of the underlying problems that have become, hallmarks of the current global economic crisis? How do you think that's going to play out in the next 2 to 3 years?
Well, it's really hard to, of course, it's hard to put your fingers on the crystal ball. One thing I think that we will probably see, we've seen the extension of central bank liquidity for longer periods and against a much broader spectrum of private sector financial instruments than in the past, and across currencies. I think that permanently in the system as it goes forward, it probably would work better if there was a well-established multi-currency Lombard facility for overnight liquidity provision. So this means the emergency measures of extending liquidity for very long periods have to be taken out. Eventually the private sector has to come back into that risk bearing. But the inefficiencies in the financial markets that come from operating in different currencies probably need to be addressed. Second thing is that the authorities will need to, at some point, mop up the liquidity that has been put into the financial system. The changes in the size of the balance sheets of many central banks are enormous. In some instances where the instruments that have been purchased are very short term, this will happen quite easily and quite automatically. But in other instances where the authorities have purchased very long dated private sector securities or liquid ones or both, and where the authorities are reaching their fiscal limits, it's going to be a major challenge to do that. So I think those two elements are going to be very important going forward, along with ensuring that we now get real cooperation in reforming the architecture of global financial regulation.
Right. The way in which the stress testing is being discussed in the US, some quarters feel that they don't have enough information. Some think they've got too much information. Some think that the worst case scenarios have not been rigorous enough, and others think it's been sufficient. What happens if the market comes back and says it's insufficient, and then you find the state now has taken on the responsibility of providing additional capital if it fails. So you have a system that is moving more and more towards the state being the answer rather than the markets being the answer.
No, I think actually ultimately the markets are the drivers of this. For example, the view that banks' Tier 1 capital should be primarily tangible common equity is a view that's come from investors and come from the marketplace. The views on the amount of leverage that financial institutions can take on this market is primarily coming from, I think, the marketplace. It's to some degree reflected in regulatory initiatives, but only to a certain degree. And actually, some regulators have said they do want banks and other institutions to hold more capital, but not right away. Sort of the prayer of St. Augustine. But no, I think actually because the stress tests were done for the individual institutions on a central scenario and a more pessimistic scenario, you can extrapolate from that. We're going to have hundreds of analysts who will be doing that. And we know we're in a situation where there are very significant downside risks. If the downside risks materialize, we could have some further deterioration of the fair valued, we call them legacy assets now, not toxic assets. Right. The fair valued assets in the bank's books could deteriorate further, although I think they're well marked for the central scenario probably now. But the other shoe which could drop, of course, is the impairments in the whole loan books. Right. And that is the area where I think there'll be a lot of analysis going forward.
Right. Let's go right into the qualitative aspects of governance that we need to deal with. Compensation. Lots of talk in terms of where compensation should go. A lot of agreement that compensation should be driven more at the incentive level for taking on risks rather than the substance of it, or rather the size of it. Where do you think the conversation is going? Do you like the fact that governments are getting involved in that conversation, although there are regulatory mechanisms to make that work? And how do you think it should be evolving?
Well, I think it's certainly evident that compensation policy in most firms, most large financial firms, was not consistent with the principle that risk-taking should be rewarded in the form of rewards for long-run profitability adjusted for risk. Why are governments involved? Governments are involved because the public is very angry about it. They feel that the levels of compensation were too high, and that that compensation was totally unrelated to actual long-run performance. And this is something which needs to be addressed. Actually, the principles for doing this were, I think, first clearly enunciated by the Institute of International Finance, as I said, in July of last year. There have since been, I think, very good recommendations by the FSB and by the European Commission. But there is a fundamental problem here, and that is that firms operate in a competitive environment. And if a firm's competitor is not adhering to the same compensation principles, then there will be competitive distortions and a non-level playing field. And I guess my worry is that while there could be a lot of sort of patching here and there in the short run, we won't in the end come up with a set of a few principles of compensation which really do align remuneration better with long-run risk-adjusted profitability in a way that, again, is consistent across firms and across jurisdictions.
Right.
Because people move internationally,
right,
as well as from one company to another.